Nerd alert! Property Nerds, the home for data-driven property investors, where we uncover Australia's hot and cold markets, latest headlines and trends.
Straight into this episode with interest rates, because whilst I love the intros, say who we are, all that stuff, we'll get to that. Interest rates have been cut, they've been announced, and why I want to jump straight into that one is last episode, or maybe it was the episode prior, me and Jackie threw out a few predictions on what would happen with interest rates. Now, I said that they should decrease it this year or this month for the call, being in Feb, but they probably won't. Now, Jackie and I both agreed, and they did actually decrease it, which is the right thing to do. But it looks like the pressure came in. They finally caved. Jackie, how's that feeling now? What's the phones and emails like ever since that happened? What's happening?
Oh, mate, it's blowing up. I think I underestimated how many people were actually waiting for that announcement. It's pretty interesting to see, they made the announcement 2:30. By 2:35, my phone was blowing up, like just all these clients coming out, like people I haven't spoke to in a while. They just let me know. And, obviously I was watching it at 2:31. I saw it. I was like, yeah, good. Although we were wrong. I'm glad I was wrong, because I know there's a lot of people need it. And it's really going to start to open up a lot more for people,
Yeah, so big learning on that is, if you're going to ask us for interest rate tips, we're not the guys to speak to. But if you're going to ask us for property, finance, my world maybe NBA tips, and then yours some horses.
Yeah.
We'll do okay in those avenues, huh? But mate, I think what's interesting to find is like a lot of people are calling, a lot of people are emailing. It's going crazy right now.
Yeah.
But is the numbers as crazy as the phones and emails suggest? And what I mean by that is like the numbers on borrowing capacity, because I get it that phones and emails are buzzing for both of us, but what about the numbers in borrowing capacity? Like, is it as big as people are thinking of it to be?
Well, to put it into perspective, right, from a borrowing capacity or like a loan repayment point of view?
Borrowing capacity.
Yeah, so borrowing capacity, not really. It's not going to make the difference. Like if you were tapped out, it's not like you're going to be able to borrow again. It might make minor differences to give you a slightly higher deposit or slightly higher purchase price. But generally, if you were waiting for this rate cut to make your move, you probably could have done something anyway. The numbers won't change too much. But from a repayments point of view, like on an 800K mortgage, you're saving about 130 a month, right? So that's not a major difference. It might be enough to put a smile on your face depending on your circumstances, but I'd argue that most people can shave off $130 a month from their budget just by looking at what they're spending rather than waiting for a rate cut. But, it's definitely, I know a lot of personal friends and, clients that definitely happy about it. They're not going to say no to a rate decrease, but most lenders, I'd say, I would say all lenders, especially for the rate cut, would, for this first one, would actually decrease their existing book and new to bank by the full 2.25. They don't have to though. Like a lot of people think, the RBA's reduced their rate, my bank's going to reduce their rate.
Yeah.
That's not always going to happen.
They don't always do it to the full amount either. Some have, some will, but they don't all have to go to the whole 0.25, right?
Yeah.
Which I find is interesting. It's a sure way to lose customers if you do that, because it's like,
well, they know that
everyone else does it. You don't. Yeah. It's a silly way to do it.
But they know that. So for the first one, because the anticipation, it's all over the news, like everyone's waiting for the rates to go down. The first one, I really anticipate all lenders passing down the full discount because people are aware of it and they know it, right? But when they start, maybe for the next one or the one after that, I think at that point, we're probably going to see, like, instead of a 0.25 decrease, maybe like a 0.15 for the existing book and new to bank. Like I saw that a lot during COVID.
Yeah.
And, when the RBA increased their rate, no doubt all the banks put it up by the exact same amount. But when they were decreasing pretty fast, they kind of hit it in the middle somewhere where they didn't pass down the full discount. So I don't see, it was funny actually, the same day the rates came out, that afternoon, there was emails from lenders just saying, yep, we're going to decrease the rate. Usually takes about 3 weeks. So not sure when this podcast comes out, but it should be just before mid-March that those rate cuts should come into effect for existing clients.
Well, I mean, what's interesting to say about that is like, you're right. There's some banks who didn't go the whole way through in COVID time. And what's really, what I find funny is that they increase it really quickly.
Mm-hmm.
And when they do it, like you said, they do it in full. But when they decrease it, I just wonder how much margin spreads there just to do like a day later or 2 day later versus a month. My gut feel is when you're talking like the mass book sizes, then you're talking the net interest margin. Like the difference between cutting that in 15 days, 2 days, or 30 days could be like millions of dollars, right?
Yeah.
And so in my head, I'm just like, I bet you they know that they could decrease it faster, but they make it 3 or 4 weeks. I mean, look, we can instantly transfer money across banks.
Yeah.
Like we can instantly log into an app and check our banking. Like I can go to a branch and they can change my, name if I show my ID, that's change the middle name and address instantly. But takes 30 days, takes 25 days because they want to collect those margins on the way through. So I get you on that one. But when it comes to interest rates, I know like what you were saying before, that was a really interesting point. Like 2 to 3% is my estimates from when we were chatting earlier about borrowing capacity improvements, right? Now with 2 to 3%, that's not going to rock the boat in terms of your next purchase. But that means there must be so many people who could have made moves.
Yeah.
But they're just sitting there going, I'm not going to make a move until the whole world goes crazy that something's dropped and interest rates have come down.
Yep.
Like, where's the logic behind that?
No, well, it's funny. The last podcast, we were actually talking about people that, look, we don't think the rate's gonna go down, although it did, but you still shouldn't be sitting there not knowing what you're sitting on and just not taking action. And people actually reached out as a result of that podcast. And, the people that are still waiting, the rate cut's gone now. They probably still could have done something earlier and they're just missing out on some opportunity cost in the market.
Yeah, 100%. I mean, I always took my personal scenario with my wife just to make sure that we're like, are we acting as we say? And this was a really special moment where I looked at since 2015 when I first got my first place to now, 2025. I've just got to make a move this year. And if I make a move this year, that means every year for 10 years, I would have made a move in the investing space. And the purpose isn't that every single person has to aspire to that. But the purpose of me sharing that is that with me making a move every single year for 10 years straight, it's to show that it didn't matter if there was a pandemic. It didn't matter if interest rates were going down, unemployment going up, labor threatening negative gearing going to be cut, borders being shut, interest rates now coming down again, businesses getting locked down. Like, it didn't matter. Like, at the end of the day, my future matters for many reasons. I've got a family to take care of. I've got generations to build wealth for. I'm able to do certain things for friends, my team, my clients as a result of my position being strong and not acting from a place of scarcity. And so if you can do all of these things, your life will change. So do not look at the news announcements and do not look at the craziness going there and just be like, oh, now it's my time because the world is telling me it's the time to do it. You've got to be accountable for yourself. You've got to be responsible for yourself and go, every year, if I can, I will. And if I can't, I can't. And don't feel like there's shame in going, I can't. And, you don't do it, because pre-2015, was I doing everything every single year? I wasn't. That was my first hit. So it took me time to get to there. And the reason why that's important as well is when we look at the data, we've seen over the last 20 years, there is always a market out there, like a council area, that has done double-digit percentage growth every single year. So that means if you've got the right team around you for finance, the right team around you for property, you're going to go in a direction, be able to find something. So if you can make it work, make it work. But if you can't, of course, your family, your budgets, your cash flow. Now, you said to me the couple $100, Jack, that if you didn't get that from interest rates, you could have got that elsewhere. What's your elsewhere? What do you reckon your elsewhere is if you go, you know what, if it wasn't interest rates, I would have cut this and I would have been sweet?
Oh, mate, probably food. I really like eating out, man. It's definitely food. Yeah.
Is it what's your go-to when it comes to the food? Is it a steak? Is it what's your thing?
Definitely steak, but mostly eating out, obviously. Eating out, bit of Uber Eats here and there. My wife's got she's got a sweet tooth, mate. She excess espresso, the cookie dough.
Oh, that's good.
Mate,
don't get me started on that. 2020 in COVID time. Yeah, we were like, the delivery driver just knew, like,
Yeah.
picking up a cookie, going to
It's
Paliwal's
funny.
place.
This one time, we surprised each other with the same meal from the same restaurant, separate Uber accounts, and the same delivery driver dropped it off as like a bulk thing.
Yeah.
And I was like, "We got a surprise for you." She's like, "What do you mean?" I was like, "I ordered something." She's like, "You're kidding." And we went out. So we had one each. It was pretty funny. But yeah, eating out, Uber Eats, that's definitely, yeah.
Yeah, I mean, that's a big one. I reckon for me, it's a subtle thing, but it makes a big difference. I always have Uber in my app, like in terms of not Uber Eats, mainly traveling for Uber, right, for work.
Yeah.
And it's that difference between the moment where I click the X versus the comfort
Oh
versus the
my God.
premium.
They show me comfort now as default.
Yeah.
They show me, and I'm like,
So that little thing there, that's my RBA 0.25
yeah.
cut.
Nice.
If I just went with X all the time instead of going all the way up.
Yeah.
Because at the end of the day, point A to point
That's
B,
it.
right?
Yeah.
But no, look, I think the reason for sharing that as well is that you don't need to wait for the next cut.
Yeah.
Because the cut could come up again, but your budgets are usually hiding a few cuts right there and then.
Mm.
But I was talking to a mate, speaking of interest rate cuts, and realizing this. If you are an investor who's building a big portfolio and you've had the cut, like just the way up on interest rates can make a bad impact. The way down can make a huge impact. Like I did the math on this, crazy amount. I got to show you this. In terms of my wife and I'm full transparent here for everyone. We've got around $9 million worth of debt. Not fun to look at, but it's actually good debt, so it is very fun. Which actually reminds me of a really quick story about my banking days. You know, when I worked in the bank and people used to come in, it's like the complete opposite to what happens in the public. When people go into the public and you go, how do I measure someone's wealth? It's like, how much cash do they have? But when I was in the banking days, how wealthy someone was how much debt I could give them.
Yeah.
Isn't that crazy? Like the world that works with money knows that good debt is what creates true wealth in this world.
Yeah.
But then it's like the world that's not talking, thinking, speaking, understanding money. When they go out to the public, it's like, oh, how much cash do you have?
Yeah.
When the bank was like, well, you can borrow X million, you must be doing well. Or you've got X assets with X loans, you must be doing well. So crazy story there, which is why 9.25 is great debt. But check out a 0.25% interest rate decrease there. $23,125 savings. So like
Per year?
that's per year, just for that one cut, which means that's a family holiday.
And a full percent would be close to 100,000.
Yeah, I mean a full percent would be $113,000.
Yeah, which most banks are anticipating a full percent this year.
Yes.
This calendar year.
So if you're out there and you're listening to me and like you may not all have $9.2 million debt. If you've got 6 million, 9 million, 10 million, 15 million of debt, the key thing for me to share with you is that if you've been vigilant and if you've been really well buffered up, if you've been smart with your investing and savings and you're not having this debt plus living it up like crazy, that 23,000 is literally a family holiday back in your pocket. Or if you're like my dad, that's a Toyota Yaris waiting in your driveway. Do you know what I mean? It's a Toyota Yaris, a brand new one. If they're still around 23, I don't know, it was 23 back in the days, but that's waiting in your driveway for you just based on one cut. But yeah, you're saying, Jack, interest rate cuts, they're not expecting it. Some are expecting it. What are you seeing is happening? Because the governor was a bit interesting with their thoughts in terms of saying, oh, look, this is just one cut. Don't think we're going to decrease more. What do you think?
Yeah, well, historically, when they do reduce rates, they do it fast.
Yes, good point.
Maybe it's a little bit different now. Yeah, it's really hard to say because even the RBA don't do what they say they're going to do. You know, so they could change their mind on a day's notice. You know, some would say they misled the public with when rates were really low and they said it was going to stay that low for a really long time, and then they shot up. You know, so you can't really take them on their word, unfortunately. I think a percent decrease in the year is very reasonable, but it could very much be more than that. You know, we've seen them. You know, we always think that the only decrease or increase is going to be by 0.25, whereas there's been times where they've decreased it by a full percent in just one meeting. You know, historically, so you just don't know. It'll be trending down though. That's the main thing. So yeah, we've got a lot to look forward to this year. Yeah,
I think that trending down on historics is a big thing to call out because like yes, I know we might be in a slightly different time to some areas, but the past is also a good measuring stick for the future. And if you see how fast interest rates have come down almost all the time, they've done that. I think the key thing to note here is that the RBA governor is saying this in that way just to keep the dialogue so people don't go too crazy
I
off
think
the
so,
back of
yeah.
it, right? Because
Yeah.
then you've got like, let's start cutting, let's start spending again.
Yeah.
Because there's going to be a few people. There's going to be some people who go, okay, I've got $1 million mortgage and I'm saving 0.25 on interest, and that's $2,500 a year.
Mm.
And that $2,500 a year is like them thinking their investing hat on. What can I do next? But then there's other people who go,
Yeah.
that $2,500 a year is a nice little gift for myself each year.
I think the language that he's using is a fear that this is going to change the sentiment in a way where there's going to be a lot more spending and there's going to be more inflation on the back of it, which is what they're trying to avoid. So maybe him speaking like that is, but we'll see.
We'll see what she gets up to in the next one. But when it comes to interest rates, that was obviously one thing I wanted to note and talk about because that's been the hot topic. One thing I'm proud on the interest rates is I resisted the urge to send an email to my database yesterday and say interest rates have cut, because there were at least, I think I got like 30 plus emails in like a span of 10 minutes to say RBA's cut interest rates.
Yeah.
And so that was one thing I'm just going to be like, I'm proud of that. I didn't do it at the same time everyone else did. So to all our 40,000 plus subscribers to our newsletters, thank you, and hope you enjoyed that. You had one less email that day from us on interest rate cuts. We will send something out though. We did send something out the day after just to say like, hey, this is our thoughts on it all. But I wanted to check in with you on one more thing, Jack, which is interest rates are one borrowing capacity shifter, but not a huge one. It will compound over time. Yes, we know sentiment's been the biggest thing that's going to change now because, as you said, our phones, emails have been blowing up, but they've been blowing up because it's people thinking they can do something or want to see if they can do something rather than, actual changes in borrowing capacity. Has there been anything that's come up on your desk of late from the banks where you've seen some unique policies that are worth shouting out, or maybe like unique ways that banks are looking at stuff that you think may make people go, okay, if I didn't know about this, I should start looking at this. And even if it kind of gets a little niched, that's cool. Just want to see what you've been seeing out there.
Nothing major, honestly. I think when the rates went up really high, it took some time for the lenders to adjust their policy to allow for more lending to go through the major channels, because I think a lot of that market share was going towards non-bank lenders, third-tier lenders, and the major banks kind of loosened up their policy to make it easier for people to borrow with them. Since they've done that, though, there hasn't been a lot of changes. Honestly, it's been pretty stalemate since then. Right now, I don't think they're going to adjust too much because it literally happened yet. Like it's only been one rate cut, so I haven't seen any new policies come out. I don't think they would need to adjust it too much. I think if anything, they might have to make it a little bit more strict because borrowing power would be coming back. So nothing yet to report, like minor things, but nothing major since the decrease. Yeah.
Now, I know there's been something though that might not be new to you, but it is something I've kind of heard and felt that like, hey, this is bigger than what most people talk about, and it's that self-employed world. Self-employed, financing has always been traditionally really tough with lots of tax returns, notice of assessments, business financials. But we're noticing a lot more lenders come your way where you're saying they're actually offering, simpler ways to do reviews of income.
Yeah.
Doesn't need so much time in business as it once did. What are you seeing out there? Because I know we have a lot of business owners as customers as well of ours, but also listeners to this show. What are you seeing?
You're right. It's old news for me, but it might be new news for the listeners.
New for me for sure. So it's good to know.
Well, a lot of times if you've been a sole trader and then you transition to a company, as like a lot of lenders would be happy with that continuance because if it's the same sort of business structure.
Yeah.
1 year financials. I mean, 5 years ago, maybe one or two lenders would look at 1 year financials. Now we've got like 5, 6. So, using wages that you pay yourself from your company.
And on that 1 year thing, just to butt in, just because that's a really big point. Some business owners go through, like, I'm thinking of a few use cases.
Yeah.
Some business owners go through, like us, we have a reinvesting year every other year. So it's like 1 year our profits dip substantially because we're investing back into the business. But then the next year, our profits rise substantially because that investment's come through the light. And so would that be a good use case to say your 2 years are way off each other
Yeah.
and you've had a really good year and we can isolate it and just look at the 1 year?
Yep.
And then second use case, if I'm understanding right, is if someone hasn't been trading for so long, that 1 year can help them as well?
Yeah. Well, funny enough, it used to be like from a major prime lending point of view, it used to be the minimum was 18 months and one lender would do 18 months ABN registration and 1 year financials, but it has to be 80% LVR.
Yeah.
Now there's a lot more flexibility there. More lenders have opened up to doing it at 18 months and some are even doing it at 12 months,
Right.
you know, and if, as long as you've got 1 year financials and you've got some continuance with your industry, but even brand new company, 12 months ABN,
Yeah.
major lending, major bank lending. So it's, it's really good, really good. But like wages as well, like if you haven't done any financials, but you're giving yourself consistent wages, like you can look at 6 months worth of that, which might be leaving.
That's a good one actually, like because if you're like really, you got ups and downs on financials, you're not getting them timely through, but you're paying yourself a regular wage.
It depends on where you're at, like what you want, because generally if you're at that higher end of your limit and you're really trying to be aggressive, you're probably going to need those company profits. But if you just, want a simple, smooth process and you just, why show all my company financials? I know they're good, or, I don't need them for this particular application. Just use the wages and that's fine.
Yeah, awesome. That's a good tip. I wanted to share that with everyone because we've been getting requests of late to go, hey, if you get any unique servicing, unique scenarios, or policies that are worth knowing, each episode will touch on a little bit of different policies that are out there. They might be very well known to Jack or myself, might be things that are common, but we all know that there's listeners from all sorts of backgrounds, whether it be business owners, certain types of professions. We'll keep shouting out little things there that that could be an X factor. And it could be the difference between you getting one place to 2 to 3 to 4. Or it could be the difference between you being in the home that you're at, but upsizing the right home or getting into the suburb you want to. So we'll keep doing that each episode. So this episode, to finish that off, was the business owners, where you have some unique but also faster ways to look at your income verification, which could open up more banks, open up more borrowing. And if you have those years that go up and down and there is a good year sitting in there in the most recent one, that could be your time to pounce. But Jack, how do people get in touch with you and the team when it comes to reviewing their finances, especially off the back of interest rate cuts? Understanding where they're sitting at, what they have and they're working with, but also if they're business owners looking at these unique policies that allow them to get a leg up and get back onto investing or buying a home. Yeah,
so just head to fouracrefinancial.com.au and click the book appointment up on the top right and you'll speak to me directly.
Awesome. Well, that's the last thing before I head into, that's the last thing on finances, numbers, interest rates. I wanted to share something a little bit personal today. And the point of me sharing this is that for those catching the video, you might be going, where's Arj's signature black top that he always wears? And why is he extra suited up today? And this reason to share it is not for you to notice that. This reason for me to share is something that I've been getting from my coach and some guidance and mentoring that I've been getting. And the purpose of me sharing is that anytime I get some of these nuggets and I'm on the podcast, I want to help out others and do the same. And what this was is an activity called Designing My Future Self. And the purpose of doing this activity was to look at creating a future self and understanding clearly who you want to be, where you want to be, and what does that future look like. This is from my coach, Simon Reynolds. And if anyone's not familiar with Simon Reynolds, he'd scaled a marketing business, I believe up to 6,000 employees, called the Photon Group, listed on the ASX. And at one point, it was worth $500 million in terms of a company. He released a book called Win Fast. It's one of my favorite books of all time. And it's something I listened to on Audible. I've repeated it 3, 4, 5 times now, 4 times to be precise. And this particular activity is on there as well. So the idea is that you have a past-based self, a present-based self, and a future-based self. The past won't let you achieve everything in the present day. The present won't let you achieve everything you're capable of, then more than you already are. And you should always focus on becoming the future self. The key is to consciously design that future you so you're happy with it. Be clear. What ways do you need to change? Take daily steps. And the biggest thing was all great things are created twice. First in your mind, second in action. And so a big part of that was Simon gave me this exercise and I was looking through this exercise, going back to his book And I wrote down everything. It was like, hey, I want to be under 80 kilos and be the fittest I've ever been. I want to be able to be that guy in the friends circle or the family circle that's dancing to any music. If I'm out on a holiday and there's a music on and no one's dancing, I want to be the first guy.
Mm-hmm.
If there's a Lebanese restaurant and they get someone on the table, I want to be on the table. Do you know what I mean? If my daughter's dancing, I want to be grooving with her. If there's good jazz music, live music, I want to hold my wife's hand, take her out there, dance with her, and be that first guy that makes things awkward for everyone, but it's always good fun. But another one was how I wanted to be as a business owner, how I wanted to represent, how I wanted to, dress and other things like that in the future. And I always felt like looking at this list, I think I put down like 23 things here or 24 things that, when I'm there, I will do X. When I'm here, I will do Y. And the problem with that is that you're constantly waiting on the when, and sometimes that when keeps changing. So you never actually do any of the things that you wanted to see yourself do in the future. So I said to myself, if I've got 20 plus things here, 23 things here, what are the 23 can I tick today? So I'm already 1/3 living my future life. This happened to be one of them. Then I thought to myself, out of the other third of things, what can I apply small steps to? And then what is the other third that maybe I can't do it just yet and it is a while away, but it's like, what can I do to be always consciously making myself aware of what that future thing is and what that future self looks like? So that's my tip for today's podcast in terms of what you should do. It's design your future self. And if you want to check out that book, it's called Win Fast by Simon Reynolds. That's Simon with 2 eyes. Shout out to you, Simon. Thank you for massively helping me with my life here with your books, as well as your coaching. So shout out there. And everyone, thank you for tuning in. Looking forward to the next episode. And the next episode, just to give everyone a heads up, we're talking SMSF. That's been a big thing that's coming up. So I can't wait to dive into that with you.
Game over.